Yes, hi guys, good evening. Hope you can hear me and hope you guys are doing well. Yeah, now, yes, let's get started. Let me share my screen and we can take it from there. Now, if you guys have been watching the recordings, you would have seen that we have reached, yes, right about here. Yeah. So, the last class we were on chapter 10. Chapter 10 was business valuation, if I remember right. And we were talking about valuing equity. We were talking about valuing debt. Yeah. So, this is the chapter, guys. Let me just take you to the beginning of the chapter. Yeah, there you go. Chapter 10, business valuations. Right. Now, it's an important chapter. It uses that one main formula that we keep talking about, that is perpetuity with growth. Yeah. As long as you know perpetuity with growth, right, at least the main formula there is very easy to do. What am I talking about? I'm talking about the dividend valuation model. Of course, not just the dividend valuation model. Yeah, there are other models required or other models that you need to know of, other valuation techniques actually that you need to know of because, well, we're talking about business valuations, right? So we saw a lot of them in this particular chapter. So, just to recap the chapter itself, this was all about mergers and acquisitions. Yes, absolutely. This is where you will have to value the company that you're trying to buy. When you buy a company, you get synergy. Not when you buy a company, right? When a parent company buys another company, you get, or the parent company gets synergy. But the synergy, a bit of it is spent to buy the company itself. So, we got to understand what is the post acquisition value. This is why valuing businesses would be very important. These were the methods that we learned, right? Now, to move forward from there, we have a bunch of portions to cover, so I'm not going to spend too much time on this. Since you guys are anyway watching the recordings, please watch the recordings of the said portions, yeah, because this is, yes, very important to your learning. Now, illustration 7 is where we were supposed to start. A good recap also of all the topics that we have started through a question. So, Ghana PLC is considering a bid for Faro Company. Now, both companies are listed, are in the same sector, business sector. Financial information on Faro Company. Yeah, which is shortly to pay its annual dividends is as follows. So I can see some, yes, some mention number of ordinary shares, the ordinary share price, X dividend basis. Yes, number of ordinary shares is 10 million. Okay, bunch of information given to us, right? Then other relevant information also given to us. The average sector P ratio is 10. The risk-free rate of return is 4.7%, and the return on the market is 10.7%. Now, calculate the value of Faro Company using the following methods, that is price to earnings ratio. Yeah, that is the dividend growth model. Discuss the significance to Faro Company of the values you have calculated in comparison to the current market values. Cool, let's check this out. So let me take a bit of this to the Excel sheet. Please note that, guys, the P ratio is 10. There are some more values given, which I'm not taking to the Excel sheet. Yeah, so let's check it out. What's happening? Yes, if you guys can see my screen. Right. So number of ordinary shares, we have been given that as 10 million. The first method that we need to use here was the dividend valuation model. No, I think one second, guys. Let me just pull up the question here also. Right. We were first supposed to use the PE ratio, the price to earnings method. Now, the PE ratio method is quite simple. You take the PE ratio, multiply it to the earnings. Yeah. So the PE ratio in this question was given as 10. Yes, that is the part of the question that I did not clip. What am I talking about? See, let me just get that part of the question also. This is what I am talking about. Yes, the average PE ratio is 10. Yeah. The risk-free rate of return is 4.7% and all of that. Okay, if I'm using the PE method, this formula is very simple, guys. Take the PE ratio, the proxy PE ratio, multiply it. Why did it turn green? Multiply it, yeah, with the earnings of the company. Yes, this is particularly useful if the company that we're trying to value is unlisted. I believe, yes, both companies in this question are listed companies. So it doesn't matter. Anyways, the average sector P ratio is 10. Multiply that to the earnings. What are the earnings of this company? Well, we've not been given the total earnings. We've been given the EPS. Well, that's good enough. If you multiply it with EPS, what you get is the price of one share. So EPS is supposed to be $0.8 per share. Yeah, 0.8 cents. which means the price of one share is, well, $8. Now, if the price of one share is $8 and the company has 10 million shares, obviously the total market cap or the total valuation based on the P ratio, not market cap, based on the P ratio would be $80 million. There you go. Excuse me. This, yes, is the PE ratio method. Quite easy, super simple. Now, what about the dividend growth model? Now, for the dividend growth model, we will have to use the formula that was based on the perpetuities formula. That is, the P0 is equal to D0 into 1 plus G divided by R, no, KE minus G. R minus G is the rate of return minus the growth rate, which is from the perpetuity formula. Here, cost of equity is the return rate required. That is why it's KE. Yeah. Now, let's take into account what the dividend would be. The dividend per share a year ago was 46.6. The dividend per share 2 years ago. Oh, yes, yes. Now we will have to calculate the growth rate, guys. So, okay. And what else is known? Yeah. Okay. So I can see that, yes, historic dividend rate is given to us. Proposed payout ratio is also there. Yeah. Technically, if I know G is equal to BRE, if I know the return on equity and I know what is the dividend being retained, not the dividend, what are the earnings being retained? You guys may remember this. What I'm talking about is the Gordon's growth rate formula. So we could actually try that here. Yeah. Let's see if we have everything that we need, right? We could use a geometric rate also because they've given us dividends like this. So I'm considering both which method to use. Yeah, let's try both. Why not? Right. So to find the growth rate, first of all, since I don't have BRE, RE is the rate of return on equity. We could actually find that out using the equity beta here. I will come to that. Or yes, what else do we need? Right. B would be the retention ratio. How many or how much of the retained earnings are being retained? We've been given a payout ratio. We could use it, but I would leave it there because there's an easier method we can do, and that would be dividend per share a year ago and dividend per share 2 years ago. I can use this to understand, right, what is the dividend growth rate. And not just that, they have told us that the proposed payout ratio is 60%. Well, technically, since I know EPS, earnings per share, and earnings per share was $0.8 per share, I can find out total earnings. Total earnings would be $0.8 per share multiplied by the 10 million shares. That gives me, well, 8 million. Yeah, if I'm not wrong. Did I calculate 80 earlier? That was $8. Okay. So 8 million, yes, 8 million would be the earnings of the company. Yeah. Now, if 8 million is the earnings and 60% is being paid out, that means the dividend, yes, would be an amount of $4.8 million in total. Yeah. So that means per share dividend, if you guys want to find out what the per share dividend would be, just divide this by 10 million. Yeah, because there are 10 million shares. $0.48 per share. This would be the proposed dividend of this year. Yeah. Now, if I put that down, we have some values. See, this year expected dividend, I can put it down as 0.48. Yeah. Dividend a year ago was also given. So, excuse me, guys. A year ago, it was supposed to be 0.46, I think. Yeah, let me just check that once. Yeah, 0.46, 46.6 cents. So that is not negative. Yeah, 0.466. Yes. And then 2 years ago, excuse me, 2 years ago, it was supposed to be 0.44. Okay, 44 cents. Cool. Now, basically, if I use the historical growth rate model, I can say that 44 cents, yeah, or $40.44, right, multiplied by 1 plus G raised to, well, how many years? 1, 2. 2 years of growth led to the dividend being 0.48. Yeah. So based on this, of course, I can find the square root and I can find out, yeah, what exactly is the growth rate. Now, let me see what they've done over here. I think they've made a mistake on what they have done. Okay, cool. All right, that can also be done. Yeah. Anyways, let's see what rate we get. So growth rate is equal to the 0.48 divided by 0.44. Yes. Square root of this minus 1 separately. So let me see what we can calculate. Now, 0.48, yes, divided by 0.44 gives me the growth rate of, okay, I have to take a square root of this. This raised to 1 divided by 2. That's how you take a square root, guys. Yeah. So square root of that minus 1. Yeah, I'm getting a growth rate of roughly 4.4%. Multiply that with 100 to make it a decimal. I'm getting 4.4%. Now, if I am getting 4.4%, right, we have the growth rate. In the formula, what else do we need? Well, D0, we know the dividend of today is supposed to be 0.48. Yeah. And what else do we know? We also know that, okay, wait 1 second, guys. All right. Ex-dividend share price is already given to us. So we already know the price. Yes. What are we trying to calculate? We're trying to calculate the value, right? So we don't know the price then. Okay. So ordinary share price, ex-dividend basis. Why is there a share price given to us if we are supposed to calculate the price for them? 1 second. Okay, we will ignore that share price for now. Yeah, market cap can be calculated using that. But yes, okay, if we're going to find the price using the dividend model, yeah, 1 plus G, we just got the growth rate. That was 4.4%. So I'm going to take 0.44, right? Because 4.4 as a decimal would be 0.044. Yeah. Divided by KE. We still haven't found out KE. To find out KE, we can use the CAPM model. Risk-free rate is known. Risk-free rate is 4.7%. Yeah. And the return on the market seems to be 10.7%. This is RM. The beta factor, the equity beta of the company is given as 1.4. Using this, I can find out KE. So cost of equity, yeah, would be simply 4.7% plus the beta factor of 1.4. I think how much was the beta factor? 1.4 multiplied by 10.7 minus 4.7. Now, what do you get? That would be 6. So let's see it. Yeah. 1.4 multiplied by 6 should be 8 yeah, 8.4, yes. And 8.4 plus 4.7 gives me 13.1% as the cost of equity. Now, if the cost of equity is 13.1%, we can take it as 13%. Now we have everything to fill up the formula. You guys can see the formula right over here. 0.48 multiplied by 1.044 divided by, yeah, the cost of equity. That would be, well, what we just calculated, 13% minus the growth rate of 4.4%. Better to take everything as a decimal, guys. Let me try solving this and seeing what the price is. So 0.48 multiplied by 1.044. This would be the numerator. The denominator would be 0.13 minus 0.044. Okay, what do I get? Okay, 8.6. Now, if I take this, divide by this, yes, what do I get as the price of the share? I'm getting $5.8 as the $5.83 as the value of each share using the dividend valuation model. So when we tried the price to earnings ratio, we got $80 million as the total value. Per share value was 8. When we tried the DVM, we got $5.83. Yeah, as the per share value, which means the total value would be, well, multiplied by 10 million shares, $58.3 million. Now, if I take market cap, which is actually given in the question, see, the ordinary share price is given as 6.6 x dividend basis. 6.6 multiplied by 10 million, 66 million is the market capitalization. This is what we can understand from the different methods here. Yeah, I hope you guys know all these methods. These methods are quite relevant. Now, let me show you guys the answer here. There's a problem with the answer. See, proposed dividend was fine, but from here they made a mistake. They were trying to find the historic rate of dividends. Absolutely cool. But what they did was they took 46.6. Yes. 44 multiplied by 1 plus G is equal to 46.6. That would be just 1 years of growth. 1 year of growth, not 2 years of growth, but they've taken a square root. So they made a mistake like that. If they were taking 46.6 and 44, then 0.48 was not necessary. I mean, it was to find out the final answer, sure. But we needn't have done all this. Yeah. So I believe there is that problem, right? They calculated the growth rate as 3%. That is not correct. And then value of the ordinary shares. Yes, again, they took dividend a year ago as D0. That is not true. Either you use D1 or D0. That is the dividend for this year. That's why we calculated 0.48. So they completely missed that point. But otherwise, yes, the growth rate is wrong. But otherwise, everything else is cool. So that is why our answer is slightly different. Their answer is much lesser. Our answer is more correct. Yeah. So 58.3 should be the right answer. Now, of course, there was a discussion part also. discuss the significance to Faro company of the values you have calculated in comparison to the current market value. Well, the current market value, or based on the market value of the share, it's $6.6 per share multiplied by 10 million shares. That is $66 million value. Yeah. Now, the PE ratio of value of this company is much higher at 80 million, right? Whereas the dividend valuation model gave us a lower value of 58.3 million. Cool. Now, Faro's PE ratio, yeah, if you look at the average PE ratio, it's 10. Yes. But if you look at Faro company's PE ratio, right? What is Faro company's PE ratio? I know EPS, yes, and I know PPS, price per share. So 0.8, yeah. 6.6 divided by 0.8, the PE ratio comes to. One second, guys. My computer has been too slow today. Yeah. So the PE ratio comes to, yes, 6.6 divided by point 0, I mean, not 0.08, 0.8. Gives me 8.25. The PE ratio of Faro company, the actual company that we are trying to compare, is 8.25. Okay. But as you guys know, in the PE ratio method, we used 10. So there is a problem. The average PE ratio is what we use. So the difference between the PE ratio suggests that there is some scope for improvement, yeah, for Faro company compared to the other companies in the industry. Quite interesting. Then moving on from there, what else can we understand here? See, these are all points of negotiation. The ultimate price of the acquisition would be based on the ultimate negotiation. We can't say that these would be the prices, right? This just gives us ballpark figures, yeah, prices that can be negotiated upon, right? So check out this answer, guys. Let's see if we missed out any points. Yes, the dividend growth model is lower than the current market capitalization at not 48. We got 58.3 million. That is the correct answer. This represents a minimum value that Faro company will go for. In this case, out of these three, yes, the lowest was the dividend valuation model. So yeah, that would be the lowest value that Faro company shareholders will accept. Yeah. If the Anna company makes an offer, was it called Anna company? Was called Ghana company. If Ghana company makes an offer, not Anna company, right? Then in reality, they would want more than this as an inducement to sell. Why? Because the market cap alone is 66 million, guys. Generally, right, investors or shareholders who hold these shares would want higher than the market cap, not the other way around. So that is a bit of a problem, right? So the current market capitalization may reflect the belief of the stock that a takeover bid for the company is imminent. That could also be market reacts to emotions. We have talked about this. When the news of a takeover goes around, people buy the share expecting the company or another company to buy those shares. So there'll be demand for the shares. That could be the reason why it is high. And depending on its efficiency, may indicate a fair price for Faro company. This market efficiency is something we will learn about in today's class. But market efficiency is the idea that, well, how fast is the news about a company reflected in a share price? How fast does the share price update? And if it is quite efficient, then this is what we would see. Alternatively, either the cost of equity or the expected dividend growth rate used in the DGM calculation could be inaccurate. Well, the ones they used in the answer here was inaccurate. Or the difference between the two values may be due to a degree of inefficiency in the stock market. That also, the fact that your dividend valuation model is giving you $5.83 per share and the fact that the market price of the share is $6.6 may be because of a degree of inefficiency, or it could be because one of the expected growth rates or something like that was not correct, because these are all forecasted numbers. Yeah. So keep that in mind. That's how you write such an answer. Now let's talk about this market efficiency. One of my favorite topics, a life advice for you guys also. I'm not sure how many of you are trading shares trying to make money. If you are, yeah, word of caution, guys, you can't simply beat the market. Yeah. You will hear about people on Instagram who traded and made millions of rupees, right? Well, they didn't make all that money. They made that money mostly through teaching other people how to trade. And what do they teach? Well, they teach basic principles. Yeah. They teach pretty much everything that we learn here, right? But they conveniently forget to teach you one thing, and that is an efficient market. Yeah. The rules of a market are very simple. See, if you know something, a lot of people would know that, right? So then how will you beat the market? This is exactly what an efficient market tells us. See, there are different levels of efficiency that we can see in the market. Efficiency means how fast is the price of a share, yeah, taking into account any news, right, or any information about the company. So in a weak market or in a no efficiency market, actually, let's start with inefficiency. Yeah. If it is an inefficient market, there is no information that is taken into the share price itself. Share price follows random, yeah, walk. In such a case, right, excuse me, yes. In such a case, yes, you can just keep a track of the past movements by looking at the graph. You can understand or you can beat the share price, yeah, just by knowing what was the history of the share prices graph. On the other hand, there is a weak efficiency market. A weak efficiency market is where past movements are already there in the price. So just by knowing past movements, you can't make any, yeah, you can't beat the market. Then there is, of course, what you need to know in this market would be public information. Yeah. Maybe like a fundamental analysis of whatever news is out there about the company. Public information can help you win in a weak market. Now, a semi-strong market is what we see in the real world. This share price will have the past reflected in it, will have the public information reflected in it. Yeah. So knowing public information won't get you anywhere. This is why I say you can't simply make money in the share market. Yeah, it's a gamble, right? So then what gets you anywhere? Well, private information actually, and that is illegal. It's called insider trading. You guys may have heard. Yeah. But private information, having private information helps you beat the market in a semi-strong efficiency market. Now, in theory, there's a strong efficiency market also. We don't see strong efficiency in the real world. We see more of semi-strong. Yeah. Strong efficiency is both, right, or is all the information that we talked about, that is past movements, public information, and even private information being reflected in the share price. So even having private information will not let you do anything. In such markets, the only way a company becomes profitable or the only way that I, as a shareholder, can make money is if I invest in proper companies that make profits. And the only way companies can make profits would be by investing in positive NPV projects. I hope that makes sense. Yeah. So this is what efficient market hypothesis, the study of that is what efficient market hypothesis is all about. It's about market efficiency, guys. So if you see your friends trying to make money on the stock market, do not discourage them, but tell them that, yeah, there is something known as efficient market hypothesis that you should look into. Right. So an efficient market is one in which the security prices fully reflect all available information. So in an efficient market, new information is rapidly and rationally incorporated into share prices in an unbiased way. Yes, absolutely. So efficient market hypothesis. See, people make money in the stock market by predicting whether a certain stock is going to grow before the stock market actually reflects the growth of that stock. Yeah, predicting the share price is what I'm hoping to do if I'm trading on stocks, right? As we all know, this is super difficult, impossible, as the market is quick to react to any information that is made available to it. So the price of a share is arrived at after people react to information or news regarding the stock. The people's reaction will affect the demand level of the stock, thus affecting its price. Yeah. So EMH, efficient market hypothesis, is concerned with how efficiently the market, the stock markets are pricing shares. So it basically measures how much information is incorporated in the share price. So the following are the various levels of efficiency. This is what we talked about earlier. Yeah. So no efficiency, guys. A market with no efficiency reflects no information. This means that the stock markets are far from reflecting real-time information, nor does it reflect past trends of the stock. You can just beat the market by knowing the past trend. So implication, people can make above average returns just by analyzing the past history of the stock and predicting its growth. This is what happens in an inefficient market. An inefficient market would have been a reality years ago when communication was not this fast. Yeah. But today, in the world of the internet, I don't think there are any more inefficient markets. Yeah. Now, let's talk about weak form efficiency. A market is said to have a weak form efficiency when it is said to only reflect information, that is, by analyzing past trends and charts. Yeah, you won't get far away. This is what would be reflected in the price. So how will you get ahead in this market? See, it is possible to earn above average returns by anyone analyzing publicly available information, for example, the latest news. So this is what would have been our markets back in the days when communication was slow, because something that I would come to know, maybe a lot of people wouldn't have known immediately, because back in the days, internet was not there, televisions were not there, forms of mass communication were slow. For example, not the radio, for example, the newspaper. Yeah. The radio was still fast, right? So anyway, semi-strong efficiency. A market is said to have a semi-strong efficiency when it is said to reflect historic information as well as currently available public information. So you can't really do anything by reading the news there. So this means that the share price will move as soon as information is made available to the public. For example, the share price of Reliance moved as soon as the news of its acquisitions were released. So implication, it is possible to earn above average returns by anyone getting private information. Yeah. This is basically insider trading, right? In reality, almost all stock markets are aimed at being semi-strong efficient. Yeah. Now, strong form efficiency. In a strong form market, the share prices are set to reflect all past public, private, information. You can't really win in that market. It is impossible to earn above average returns, as not matter how well you analyze real-time information. Doesn't matter. Yeah, you will not have access to private information, thus your predictions could go wrong. Even if you did have access to private information, the only ways to return here will be illegally. Well, guys, that will be with respect to private markets, not with with respect to semi-strong markets, private information, not for strong form efficiency. I think that table is a slightly wrong. Yeah. Strong form efficiency market. See, this is the right one. See, in a strong form efficient market, presentation and timing of results are irrelevant. Managers should concentrate on investing in projects. Yeah, that yield positive net present values. Remember what I told you? In the strong form efficiency market, every information about the company is already reflected in the share price. So you can't really beat the market by knowing something about the company, even if it's private information. So this is why companies have to invest, or companies have to be run by good directors. We invest in good companies, get returns. That's all you can do. So this right here, guys, is not correct. Please note that you will not have access to private information. That pertains to the semi-strong efficiency, not strong form efficiency. This table is still correct. Yeah, it says impossible here, which is true. You can't make returns by trading. Yeah. So the closer to strong form efficiency our markets are, the more of a gamble stock trading becomes. Right. Now, let's look at illustration two. What's happening here? What would you believe about the efficiency of the market if you thought you could make money by insider dealing? Well, that would be semi-strong. Why? Because insider dealing is the idea of having private information, and then using that in the market to make some gains. Sure. Then analyzing past price movements would work in a non-efficient market or zero efficiency, not efficient, non-efficient, not efficient. Yeah. Inefficient market, I would say, not call it not efficient, inefficient market. Then what is only by pure luck? This would be strong form. That's why I said it would be gambling in most of our markets. The closer we are to a strong form market, right, the lesser the chances of, well, making a tactical profit. A lucky profit you can make, sure. Analyzing financial statements, director statements, company activities, all of this, yes, would be helpful if you had a weak form efficiency market. Why do I say weak form efficiency? Because weak form efficiency means only past price movements are reflected in the share price. If you know anything beyond that, that is public information, can definitely help for you to win in that market. So you guys can see the answers here. Moving on from there, here's a question. Oh, saw the answer. If the capital market is semi-strong efficient, investors will be able to make consistent gains by studying and making use of past share price movements. Definitely not. That would be in a weak form efficient market. Investors will be able to make consistent gains by studying and making use of all available public information. Yeah. This would be in weak form. Sorry, guys. This would be in inefficient. Yeah. Then investors will be able to make consistent gains by studying and making use of information which is not made available to the public. Yes, that is semi-strong. That is the answer to this question. Investors will not be able to make consistent gains. Well, that would be strong form efficiency, as you guys know, because there is no way to predict the market. The answer to our question is C, because we were looking at semi-strong efficient market. Yeah. So semi-strong efficiency is the fact that only private information, knowing that, helps you win in the market. So remember this, guys, you're not losing in the stock market because you didn't learn something. You're losing in the stock market because the stock market is rigged to behave like that. Yeah. So practical considerations in the valuation of shares and businesses. Excuse me. What else do we need to look at when we look at shares and businesses and how they're bought and sold and all of that? Well, liquidity and marketability of shares, of course. Value of shares of unlisted or private companies is based on valuation techniques. However, it is always difficult to sell these shares, thus questioning their valuation. That is true, especially unlisted companies. For example, you're investing in a company that, these companies like the companies that come to Shark Tank, the private limited company. How easily are these shares of those companies or your ownership share in that company? How easily can you sell it? That's a big question. Yeah. So availability of information is also another problem. If you were to analyze the value of an unlisted company, that's not going to be easy. See, for unlisted companies, there are multiple reasons why information is not readily available. Unaudited statements, fewer compliance requirements, the weaker control add up to these reasons. This is availability of information. Then volatility of shares, that also share prices are very emotional. Yeah, share prices tend to be volatile if there are few companies in the industry. Thus, getting correct and equilibrium prices becomes a difficult task. Yeah, absolutely. If there are a few companies in the industry, share prices, the average share price in the industry also going to be very volatile. I may not be able to use any proxy values quite clearly. Yeah. So these are the problems with, well, valuations of shares and businesses. Yeah. So illustration 10, let's check it out. Mon Incorporated is an all equity finance company, has 10 million shares in issue. Yeah. Its share price is 270 cents per share. It is considering a takeover of Iridium SOX, a company in the same industry. Now, Iridium SOX is also equity financed. Okay. Has 5 million shares in issue. The share price of Iridium SOX is 135 cents per share. The takeover is likely to result in synergy gains estimated to be worth a total of $2.5 million. Okay. The financial advisors of Mon Incorporated have indicated that if an offer is made at a 20% premium to the current market price, this is likely to be acceptable to the shareholders of Iridium SOX. So basically, you guys have to calculate what may be acceptable to them. So check it out, guys. First question: if Mon Incorporated has sufficient cash available to finance the takeover, estimate the total value of Mon Incorporated post takeover and the value of each share in Mon Incorporated. So post the takeover, of course, there is a company being taken over, Iridium SOX. So that company's value will also add on to Mon Incorporated's value. Along with that, there may be some synergistic gains also. I think there was some mention of some synergy. Let's check it out. Let's take this to an Excel sheet. So all right, here you go, guys. Yes. So Mon Incorporated has sufficient cash available to finance the takeover. Estimate the total value. Okay. See, first of all, what do we know about this Mon Incorporated? Mon Incorporated has 10 million shares. Number of shares, right, is 10 million. Cool. Then its share price is also known. Okay. That seems to be $2.7. Yeah. 270 cents per share. It is considering a takeover of Iridium SOX, a company in the same industry. Okay. Iridium SOX is also equity finance, has 5 million shares. Now, so I can mention some things about Iridium SOX then. Yeah. What a company name. Right. 5 million shares it has. And what is the share price? It's 135 cents, so $1.35. I hope you guys agree. Yeah, these dollars are per share. That is share price per share. Then the takeover is likely to result in synergy gains. So there you go, guys. This is what I was talking about. Synergy is mentioned, estimated to be a worth of 2.5 million. Okay, wonderful. Now, the financial advisors have indicated that if an offer of 20% premium is made to the current market price. So first of all, the current market price is 1.35. Yeah. So what if a 20% premium, right, is paid? Yeah, that is the idea. Let's check it out. When is this takeover supposed to be? Okay, cool. So anyway, what is the value of Mon Incorporated? What is the value of what is the value of Iridium SOX? This is what we would calculate. See, market cap of Mon Incorporated is 10 million multiplied by $2.7. 10 million shares multiplied by $2.7 per share. That is a value of $27 million. Now, for Iridium SOX, the market cap would be 5 multiplied by 1.35. This will be $6.75 million. Now, the interesting thing is when these companies join together, of course, that's 27 million of Mon Incorporated's value. Yeah. Plus this Iridium SOX, I'm just going to write IS. Yeah. IS's value of 6.75 be adding on. right? And the synergy gains of 2.5 adding on, which means the total value of the company would be 36.25. But hey, hold on, there is a problem. How are they going to pay for this company is a question, because Mon Incorporated has to pay for it, right? To take over, yeah, the said Iridium SOX. Then only they get the synergy also. And for this takeover, I believe they're supposed to offer a cash prize. They are offering cash in the first case anyway. And how much cash are they offering? Cash offer. Well, the cash offer, the cash or the price of this, yes, it is $1.35 for Iridium shares, but they want a 20% premium. So that will be multiplied to 1.2 to increase it by 20%. I'm getting 1.62, multiply that by 5 million shares. The offer should be for $8.1 million, which means this needs to be subtracted from this equation. Why? Because Mon Incorporated would be paying this to get the synergy and to get the well, to get the synergy, they have to get the subsidiary. They have to buy Iridium SOX. To buy Iridium SOX, they have to spend 8.1 million. That's why I have to put the cash consideration here. So the total value of the new company will be 28.15 million. If that new company, that is Mon Incorporated itself, has 10 million shares, the value per share will be the value per share would be $2.815 per share. Now, if you look at the old share price was 2.7. Yes, which is great. That means the increase in the share price is not 1.15. It's about 115, no, not even 115, 11.5 cents is the increase, is the return that, yes, each shareholder is getting. Yeah. Yes, that's it. Right. 1.15 is all that the increase is. Yeah, because it's 2.815, yeah, per share. Cool. This is the increase. If you take that as a percentage, take that, divide by the old price, multiply by 100 to find out what is the rate, yeah, increase. The growth is 4.25% if you guys calculate it for non-incorporated shareholders. For well, Iridium stock shareholders, they're getting a 20% return or a 20% gain, because for shares worth 1.35 and totally worth 6.75, they're getting 8.1. That's what, yeah. Now, in the second case, Mon Incorporated offers a share for share exchange for the shares in Iridium. Estimate the total value of Mon Incorporated post takeover and the value of each share in Mon Incorporated. Okay, cool. So the Mon Incorporated in this case, first off, guys, we are giving shares, right? Not just cash. Are we giving share for share exchange? Yeah, estimate the total value. Okay. So we are giving shares. So value of Mon Incorporated, wait, not Mon Incorporated, value of Iridium stocks, we are already calculated as 6.75. I hope you guys remember $1.35, the market value of the share, multiplied by 5 million shares. This is the value of the Iridium stocks company. Yeah. Now, what was, what were we planning to do? We were planning to give them shares. Yeah. So if they are planning to give them shares in lieu of this, right? What is supposed to be the post share value of ours? It is supposed to be 2.815, because the addition still remains the same, guys. We are going to give them, instead of cash, we're going to give them shares, but the shares will have the value of $8.1 million. Keep that in mind. Okay. So if that is the case, right, we take the $8.1 million divided by our expected share price after the acquisition. See, expected share price after the acquisition is definitely going to be 2.815 itself. Yeah. And why do I say this? Well, I say this because I can see that the synergy is 2.5 million. Yeah, the takeover, right? And we also know that, well, what else do we know? Okay, actually, yes, we do know that also. Okay, wait, I'm not going to confuse you guys. Let's keep it simple. Value of Iridium stocks is 6.75. For this, we are going to give them shares. Shares worth how much? Shares worth 8.1 million. Yeah. So technically, right, the value that, or the gain that the shareholders of Iridium stocks are getting is 1.35 million. Yeah. Share of synergy to Iridium SOX's shareholders. Please note that, guys, the subsidiary shareholders. Why? Because they are giving up their shareholding in Iridium SOX, which had a value of 6.75. And what are they getting in lieu of that? Well, they're getting 8.1 million in shares, but they're getting that. The value is, yeah, the value is that. So because of that, the difference is the gain they have. This comes from the gain in synergy. The total synergistic gains is supposed to be 2.5 million, if I'm not wrong. We had used that in a calculation earlier. So then minus 1.35, I can get, yes, that this is the gain that would go to gain going to what was the parent company's name? The parent company was called not Iridium Sox, Mon Incorporated, of course. Yeah, the gain going to Mon Incorporated's shareholders, which is something that we actually calculated earlier. Why do I say that? See, 1.15 million, yeah, dollars, right, is the gain. Cool. Per share, what is the gain then? Yeah, per share would be simply divided by 10 million shares because that's what Mon Incorporated has, if I'm not wrong. Yeah, existing 10 million shares because I want to know this is again going to the existing shareholders of Mon. Okay, keep that in mind. So as of now, before pre-acquisition, it's 10 million shares. This would be the gain going to each share that has a value of $2.7, which means we arrive at the same post-acquisition value. Yeah, that is $2.85815 per share. Yeah. Now, if we know that, we can figure out how many shares need to be issued. This divided by 2.815 gives me 2.877 million shares that need to be issued to achieve the amount of 8.1 million. That's it. Yeah. So that was that question. I hope that is clear to everybody. Let's go back to the question and check out the answer here. So what have they done? Yes, 1.2, 1.62. The total would be 8.1. So if it was a cash consideration, yep, this is what is happening. Mon Incorporated will not have issued any new shares, and therefore the post takeover share of Mon Incorporated will be 28.15 divided by 10 million. There is an increase of $1.15. No, there is an increase of 11.5 cents. Yeah, or $0.115. Please be careful of that, guys. That's a mistake there. Then, in this case, Mon Incorporated will offer shares worth 8.1 million to finance the takeover. We can calculate the post takeover share price by considering the split of synergies and value of synergy gained by Iridium Sox. Yes, the same calculation that we did. That was because they're giving up their $6.5 million shareholding to get a shareholding worth 8.1 million. This is the value or the gain they're getting from the takeover. Yeah. So the remaining goes to non-incorporated shareholders. So as a result, the value of the existing 10 million shares post takeover will be 27 million plus 1.15, 28.15, which translates to $2.815 per share. So in order to settle the 8.1 million consideration, yeah, the rest of it is absolutely correct, guys. Wonderful. With that, we come to another question, illustration 11. What is this question? San Senova company has an issue 8% bonds. Okay. Before we get into that, let's take a small break. I think that's the last question also. So we'll come back to that. And then in the next hour, we will start, yes, on working capital management. So 20 minutes, guys, and then we get back to it. Yes, this is expected to grow at 10% per year for the foreseeable future. Excuse me, I think there was some internet issue. Right. For the foreseeable future, okay, the debt holders of Sands Nova Company require a return of 6%. Calculate the following current market values of each $100 convertible bond. All right, let's get to it. Let's take this to an Excel sheet. It's quite easy. We already know what to do. So let's see if I put it over here. I hope you guys can see my screen. So let's get started. Now, market value, right, is calculated based on what is the present value of all the returns that you can get from the share. So for this, we need to put down the cash flows involved in this share, and that would be, yeah, we have 3 years of cash flows. Year zero, year one, year two, year three. Okay, now year one to three, what's happening? Well, $8 every year because it's an 8% bond. And in the last year, we have to decide if the the bond holders would go for conversion or redemption, which means we got to figure out what is the redemption value and what is the conversion value. I believe redemption value, we know redemption value would be, 1 second, guys. Yes. So, which are redeemable at their par value of $100 in 3 years' time. Yes. And what is the redemption value? Redeemable at par value. Okay, redeemable at par value means $100 itself is the redemption value. Cool. Conversion value, on the other hand, would be 80 shares. But what is the expected share price by the time conversion happens? Now, conversion happens 3 years from now. So we got to figure out by that time what is the value, or excuse me, yes, what is the expected value of the share. If the share is expected to grow by 1.1%, sorry, 10%, that is multiplied by 1.1 raised to 3, 10% for 3 years, right? The expected share price is 1.53. Now multiply that to 80 shares, we will get the conversion value. So the conversion value seems to be better. So please take that into account for calculating the market value of the company. Now I'll take the totals here. Totals of all the cash flows that can come up year one, year two, year three. So these are the cash flows that we need to take into consideration. Now, how will I find the present value of this? What discount factor should I use? The discount factor that has been given here is 6%. We should use the discount factor of debt holders, or generally the rate of return required by debt holders without a conversion option. That is what we will use as a discount factor. Here, anyway, the debt holders of San Senova require a return of 6%. That is clearly given to us. So use that, guys. You can use an annuity factor for 3 years and a discount factor just for the third year, or you can use 3 years, three discount factors. That also works. So 1 divided by 1.06, that will be the discount factor for the first year. Second year raised to 2. The third year, this will be raised to 3. All right, wonderful. Now then, let's calculate the discounted cash flow or the present value. This will be $8 multiplied by 0.94. Okay. $8 multiplied by 0.89, right? And $8, sorry, 130.452 multiplied by 0.84. These are the values that we get. If I add them up, we have the market value of the share today. So market value is 124 point, well, $2. There you go. Now, what is the floor value? Well, guys, for the floor value, it's the same calculation, but floor value is like the minimum value. So what is the minimum value of the share? Well, without any conversion, right? I can still get $100 for the share, and that, guys, is the minimum value. So what if, as a debt holder, I go for conversion? Yeah. Or what is the minimum that we're guaranteeing them? The minimum we are guaranteeing them is the par value of $100. So that's why we take that into consideration over here, right? And you guys can see how I've put the $100. Same formula, same table, all of that. And I've calculated the total of the present value there. And I'm getting 105.34. Yeah. So this is the floor value. Now, what is the conversion premium? See, conversion premium is a comparison between, right, the value of the convertible shares right now, the potential shares. What is, yeah, we can get 80 shares. Currently, they have a value of 1.15, if I'm not wrong. It was mentioned in the question that the shares trade for 1.15. So as of now, these 80 shares only have a value of $92. Then why am I paying a market value? Yeah, for this instrument of 124.19716. Well, the difference between these two, market value minus the conversion value, yeah, gives me the conversion premium. I hope this is clear, guys. just for you guys to understand. It's market value minus the conversion value as of today. Yeah, convertible shares value, right? The potential shares value as of today. We take that, we compare that. The difference between them gives us conversion premium. That is $32 here, 32.2. Yeah, there you go. Right. So that is that. With that, we come back to the textbook once again. I believe we are done with all the questions. You guys can see it. Yes, the answers here, floor value, the market value. 32.2, the conversion premium. If you divide that with 80 shares that you're supposed to get, you can figure out what is the premium that you're paying per share for being able to convert 3 years from now. Yeah. So check it out. That is that. Now, moving on from there, let's talk about the next chapter, and that would be working capital management. This is an introduction into it. So let me give you guys an introduction before we jump into it, and then we'll talk about it. So what is working capital? It's the money that runs the show. You guys may know about it. I believe you guys do. Make sure you do, right? It is quite important, yes. So working capital is simply the balancing act between profitability and liquidity. Why do I say this? Well, I'll give you a simple example. If I see, if I want to attract customers, especially business customers, I have to give them a payable period. Now, a payable period is the time, yeah, that my customers can take to pay me, right? So that's a payable period, no problem. Now, so I have to give them some sort of credit. Now, the problem with giving them credit is that if I give them some, yeah, time to pay me back, that time I don't have money, right? I have to fund that time. So that's a problem. This is what creates working capital, right? By running the show, I mean, this is how the show is run. Think about it. You buy some inventory. Yeah. What are you creating? You're creating payables. Yes. You have some inventory sitting in your, you have some goods that come to your inventory. Yeah. Let's say it sits in your inventory for a few days before being sold, right? Let's say it sits for 20 days. Yeah, before it gets sold. Those 20 days, let's say you bought this at $1 million, okay? Some goods. You're planning to sell it at 1.5, no problem. Yeah, that's the profit. Yes. So $1 million worth of inventory that sits in your inventory or in your warehouse for 20 days. Those 20 days, you're not getting any money. These are known as inventory days, right? Then you sell it. The sales, we don't get cash immediately. It goes to receivables. Later only we get cash. When we get cash, or yeah, basically it goes back to the whole buy equation again. So tell me this, the time it takes to receive money, right? Let's say that is 30 days. So a total of 50 days then, yeah, 20 plus 30. 50 days I don't have money, even though I have spent 1 million to buy my goods. Well, technically, I haven't spent the 1 million yet. Yeah. Maybe my supplier gives me a payable period of 25 days. How about that? So if my supplier gives me a payable period of 25 days, I don't need money for 50 days. Yeah. I need money from the 26th day onwards, or basically, if I subtract the 25 from here, I need money for the remaining 25 days. I hope this makes sense, guys. Yeah. Basically, receivable days and inventory days are not good for us. Payable days are super good for us. But payable days, right? But without receivable days or without inventory days, also, we may face problems. Why? See, if you were trying to keep your inventory very low, your inventory days can be kept very low. But the problem is higher chances of stock out, production stoppages, things like that. If you're trying to keep your receivables low, that is also possible. You can collect money from all your customers, you ask them to pay up soon, all of that. But the problem becomes that, well, that is if you're not giving receivables to your customers will go to other people who are giving them receivables, no, or who are giving them credit period. Yeah. So that becomes a problem. So payables, on the other hand, the higher they are, the better payable days. But that will, well, won't rub off so well with our suppliers. So that is also another problem. This helps us calculate what we call the working capital cycle. The higher the number of days, guys, the more money that would be required to fund it. Yeah. The higher is the working capital requirement. We essentially want to balance this because we need money on hand, liquidity, but at the same time, we want to be invested in things like receivables and inventory. So as to increase profitability. Yeah. So introduction, then let's get into it. Working capital is defined as the excess of current assets over current liabilities. Absolutely. There is a formula like that. Current assets minus current liabilities. Why? Well, it's basically inventory plus receivables plus cash minus your payables, if you noticed. Same thing that we were talking about in days over there. And this is in dollars. Yeah. Now, it is basically the capital available for conducting day-to-day businesses of an organization. The funds you need for your day-to-day working are basically working capital. Yeah. Now, The main objective of working capital management is to find the right balance between profitability and liquidity. That is very important. Inventory, receivables, and cash are current assets and they all require funding. What does that mean? See, so you need to buy material for production and you are a new business. How do you pay for this material? You go to a supplier, purchase with a promise to pay him or her after a set number of days, after a set time period. Yes, of course. So now because you did not have the resource for your day-to-day now you did not have the resources for your day-to-day operations, you financed your purchase of material by taking credit. Yes, that's what it is. Now think of the accounting here. Yeah, it would be debit purchases, credit payables. Yeah. It will be purchases stock to supplier's account credit. Yeah, you create a payable in the supplier's name. Now, your current asset, that is stock, is financed by your creditors. Yeah, so this is what we see. Now, then, yes, the trade payables and overdraft are current liabilities that are the short term sources of funding available. Mhm. Of course, your current liabilities. Yeah. So payables plus overdraft, you could say. Generally, if we have a positive cash balance, we don't see overdraft. If we don't have any cash, we will see an overdraft balance. Yeah. Overdraft means negative cash balance, guys. You're overdrawing on your account. Companies do get that option. Even people actually get that option. It's like a credit card for a company. Yeah. Now, the following are two decisions that a business needs to make with regards to working capital: the level of investment required in current assets and the type of finance used to fund these assets. Yes, absolutely. Very important. So, check it out. Elements of working capital: current assets minus current liabilities is equal to working capital. Correct. And what are these current assets? Inventory, receivables, cash, and bank. What are current liabilities? Bank overdraft and your payables. Yeah. Now, so working capital management then deals with the management of all these things, of course. Right. Now, that being said, yeah. Objectives of working capital management: ensure smooth operating cycle. Yes, very important that you do. Yes, ensure that the working capital cycle is running smoothly. Then optimize level of working capital. Yeah. Minimize the cost of capital. Achieve optimal return on current assets. These are all objectives of working capital management. Very important. Yes, as can be imagined. Now, the level of investment required in current assets. See, naturally, yeah, it would be preferred to hold a high level of current assets. Yes, it's good to have a lot of money in your wallet, sure. But is it making you money? No. So then ideally, right, you shouldn't have too many current assets. Okay. So it would be preferred to hold a high level of current assets as the organization will be able to respond to any changes in the business promptly. However, a high level of investment in current assets will result in an increase in the cost of holding cash or inventory or management. Yeah. On the other hand, if current assets are underinvested, the company may be unable to respond to changes in demand and business conditions, even if it is a less expensive option. Yeah. So you need an ideal balance then. Yeah, you can't have too many current assets, but at the same time, you can't have too little current assets also. Excuse me, guys. Now, factors that must be considered when determining the level of investment in current assets. Yes. Industry in which the organization operates. Yeah. Depending on your industry, the level of current assets required, the level of working capital required would be different. Yeah. So certain industries require considerable investment in working capital and have long operating cycles. Yes. Others have shorter operating cycles and therefore require significantly lower investment in working capital. Think of restaurants versus construction companies, guys. Both are businesses, both have working capital involved. The working capital cycle in a construction company would be quite long, whereas the working capital cycle in a restaurant company or a restaurant would be much lower. Now, working capital policy. The company's working capital policy, funding policy will also affect investment levels. Now, the company chooses between a conservative, less risky but expensive approach. A company can choose between them, or an aggressive, risky but cheap route. Yeah. And a moderate, middle of the road approach. Yeah, moderate would be the best way to go, ideally. Now, these are discussed below in detail. We will learn about them in just a second, guys. Also, to keep in mind, another factor that must be considered when you think of how much to invest in current assets is the terms of trade. See, the terms provided to consumers and collected from vendors for receipts and payments of dues also influence the degree of investment. Absolutely. If I want to give big receivable period or big credit period to my customers, and if I want to give them big receivable or credit balances also, I would need to invest a lot of money in that. Absolutely. And payment of dues is another thing. Yes, the fact that you will have to pay dues. Yeah, with your suppliers or how often you have to pay would dictate the level of payables that we have. Yeah, these things dictate, yes, the investment in current assets such as receivables, most definitely. Now, the investment level will vary depending on the terms given to the company. Now, moving on from there, guys, let's talk about the type of finance used to fund current assets. Excuse me. Now, the funding is required for both forms of current assets. And what are these two forms of current assets? Well, there are permanent current assets and fluctuating current assets. What does this even mean? Excuse me. The whole idea of current assets was that they keep fluctuating every 12 months, right? So, what does this mean? Well, I'll give you an example. Imagine, okay, in my wallet, I think there is always a 500 rupees kept under my license. I'm sure a lot of you will have one 500 rupee note like that, or maybe 1,000 rupees, or even 2,000 rupees. Not so common nowadays. Yeah. So, anyway, can I say this is more of a permanent current asset because that balance is always there? Whereas everything else that comes and goes into your wallet would be the fluctuating current asset part. Yeah. So, how do you fund the permanent current assets? How do you fund the fluctuating current assets? This would decide how much risk you're taking in your working capital, yeah, funding approach, right? So permanent current assets, a constant level of current assets such as buffer inventory or a minimum amount of cash in the bank. Absolutely. Fluctuating current assets, not fluctuation, fluctuating current assets. Yes. The part of current assets that is constantly changing, such as receivables and payables. Yeah. Now, we look at these three different financing mechanisms that could be used to finance current asset investments to get better understand the strategies. Yeah, three strategies. We'll divide current assets into three categories. Okay. Check it out, guys. This is not current assets. This is all assets into three categories. The three categories of assets would be non-current assets, permanent current assets, as we talked about, and fluctuating current assets. So how should, yeah, non-current assets ideally should be funded through long-term finance because we're talking about long-term assets, right? Then why not? Yeah. On the other hand, fluctuating current assets should use short-term finance. Agreed. But what about permanent current finance? I mean, permanent current assets. Should we use long-term finance or short-term finance for it? That is the problem. Yeah. So let's see the three approaches then. Check it out, guys. Conservative. It's mostly long-term that will be used. Yeah. All permanent and most fluctuating current assets are funded using long-term finance. If too much of long-term funds are devoted to funding current assets, it results in overinvestment. Yeah, you're taking long-term loans to fund your current assets. That's not a good sign. If you're overly funded or if you've excuse me, yes. If you've invested too much, yeah, it results in what we call overinvestment or overcapitalization, yeah, which can have a negative impact on profitability, of course. Then the aggressive strategy, yeah, the majority of the time, short-term financing is used, the opposite of a conservative strategy. Short-term finance is used to cover all the volatility as well as a proportion of permanent current assets also. We can't call it the balanced approach, guys. A conservative approach will result in lower profitability, more cost, but lower risk, while an aggressive approach will result in higher profitability, but higher risk. Now, moderate strategy, on the other hand, long-term financing is used to fund permanent current assets. Short-term financing is used to fund fluctuating current assets. We can call this the balance approach. Yeah, absolutely. I hope that makes sense, guys. Yeah, depending on what kind of current assets we're dealing with, use either short-term or long-term finance. That is the moderate strategy. Now, moving on from there, short-term finance, yes, is usually cheaper than long-term finance, but the risk is, yeah, higher for this is because, yeah, risk taken by creditors is low. But even though it is cheaper, the point is that short-term finance can be renewed in the short term also. Yeah. So if you're relying on funding your permanent current assets using an overdraft or something, an overdraft has to be renewed every year. So next year, will you have the overdraft is a big question. So for example, if a bank were considering two loan applications, one for 1 year and the other for 20 years, all things equal, yeah, being equal, it would demand a higher interest rate on the 20-year loan. Absolutely, 20 years of interest, no? More the time in short, or more the time there is a loan for, more the interest. Yeah. Now, this is because it feels more exposed on long-term loans as more could go wrong with the borrower over a period of 20 years than a period of 1 year. Absolutely. It means to say that longer the time, guys, longer the volatility, longer the risk involved. Yeah. Now, the risk of short-term finance, we have renewable problems. Short-term finance may need to be continually renegotiated as various facilities expire and renewal may not always be guaranteed. Unstable interest rates. If the company constantly has to renew its funding arrangements, it will be at the mercy of fluctuations in short-term funding. Yeah, short-term interest rates. This is the problem with short-term finance. Yeah. No, just give me 1 second, guys. I'll just get some water. Yeah. Yes, sorry about that, guys. Yes, back to where we were. So, risk of short-term finance, we just talked about it. Then, profitability and yeah, liquidity that we talked about earlier. See, what brings in profitability? Should we use the funding based on fixed or variable interest rate? What are the tax implications of this? Should we borrow in another currency? Can we forecast funds easier? Yeah. Ability to find favorable rates and the term to maturity would definitely affect the way we fund it. Now, the safety problem is risk. Is the cash best invested in a foreign currency? Is there a risk of losing some of the capital? Is the future spending subject to inflationary risk? We have to think of all of these things before deciding how much working capital we need. Now, over trading is the term, yeah. To use in this context, if a company's ability to meet working capital requirements, excuse me, guys, it's a sandwich I had not sitting with me. Is dependent on its liquidity needs from short funding and poses a significant threat to the organization. Now, overtrading indicators include a rapid rise in turnover. See, when we say overtrading, we mean that the revenue is going up quite heavily, right? A rapid decrease in the current and quick ratios, a large portion of short-term debt, current liabilities is used to fund the current assets. So you can see current assets and current liabilities going up, your quick ratio, current ratio going down. Yeah, and you will see an increase in revenues. How does this happen? Well, this happens when overtrading happens. And what is overtrading? Well, it's basically selling to any Tom, Dick, and Harry possible. Yeah. So, what happens in overtrading is that the company extends the credit limit it offers to its customers, offers them a higher time limit for making the payment, keeps a higher level of stock than is necessary to meet the current level of sales. Yeah. This is what happens under overtrading. Right. Now, that being said, working capital ratios. Now, these ratios may be used to analyze the effectiveness and efficiency of the working capital management process within an organization. So these can be separated into two areas, liquidity and efficiency, efficiency forming the operating cycle. So liquidity ratios, current ratios, it measures whether the company has sufficient current assets to meet its current liabilities. Yeah. Quick ratio is simply the same as current asset divided by current liabilities, but take out inventory from it. You guys should be knowing these ratios from before. Yeah, these shouldn't be new to you. Why is that called the quick ratio? Well, it's simple because we only consider what is most quickly convertible to cash. Inventory is probably not so easily convertible to cash. Now, there are some efficiency ratios also which help us calculate the inventory days, receivable days, payable days, and such guys. So, inventory days are calculated by taking inventory, dividing it with the cost of sales multiplied by 365. Now, when I say take inventory, you can use the best is an average balance, of course. But for the sake of our calculations, we will be using the year-end balance. This is what investors also use because that is what is easily available to us in the financial statements. Yeah. So we assume that the level of inventory is, yes, whatever it is at the year end. Cool. So that is the level of average level of inventory. We assume that. Now, receivable turnover or debtor days. This is essentially the time required to recover cash from customers, those who have availed credit. Of course, that is receivable days, receivables divided by credit sales multiplied by 365. Now, payable turnover or credit days, right? This is the length of time required to pay suppliers invoice. That is payable divided by credit purchases multiplied by 365 gives me payable days. Now, working capital cycle, on the other hand, is what we saw at the beginning of this chapter, guys. Inventory days plus receivable days minus your payable days gives you the cash conversion cycle, or what we call the operating cycle. Now, this is known as the length of time it's been since you've bought a good, yeah, and will have received the money. Absolutely. All right. So moving on from there, let's check out the cash operating cycle. The cash operating cycle is the same working capital cycle. Yeah. If you take everything in dollar value, you get the amount of cash required, amount of working capital required. So cash operating cycle, known as working capital cycle, is the number of days between paying the suppliers and receiving cash from sales. It can be measured in days, weeks, or months. Yeah. Cash operating cycle is equal to inventory days plus receivable days minus payable days. Now, in the manufacturing sector, inventory day has three components. That is raw material days, work in progress days, the length of production process, and finished goods days. Yeah. Yes, that is simply speaking. See, if you're a manufacturing company, it won't be simply inventory days, guys. You will have three levels of inventory. What are they? Raw materials. Yeah. Your work in progress and your finished goods. So we have to take that into account. Right. So calculation of operating cycle for a manufacturing business, check it out. Raw material holding period. Yeah. Minus payable payment period, not necessary. You can put this at the end also, no problem. You guys can see the only difference is that inventory holding period would be split into three. Inventory days will be split into raw material days, work in progress holding days or work in progress days, finished goods days. Yeah. Now, calculation of the cash operating cycle for wholesale or retail business. Inventory holding period less payable payment period. Yeah, receivable collection period gives you the cash operating cycle. Meaning of a negative cash conversion cycle. If a company has a negative cash conversion cycle, it means that the company needs less time to sell its inventory or produce it from raw materials and receive cash from its customers compared to time in which it has to pay its suppliers of the inventory or raw materials. See, this is reminiscent of what happens in a supermarket, guys. When I go to a supermarket and buy things, or when you guys do that, you're not going to pay them in credit, right? You have to pay them then and there, which means supermarkets don't have receivable period because they're retail sales, right? But they do get a payable period from their suppliers. Yeah, credit from their suppliers. This way, the working capital cycle can be negative. Can be, doesn't always have to be, but can be, which means you're receiving cash faster for selling inventory than when you have to pay for the inventory. Yeah. Or before you have to pay for the inventory. I hope that makes sense, guys. So here's the positive cash conversion cycle and negative cash conversion cycle. Yeah. The inflow is slower, but outflow happens quickly. That is before you collect cash. This would be the positive cash conversion cycle. The negative cash conversion cycle, inflow is quicker, happens before you are required to pay suppliers. Yeah, you get the money or there are no receivables as compared to payables. That's the idea. Yeah. Now, operating cap cycle ratios. Inventory holding period is inventory divided by cost of sales into 100. Yes. Excuse me, guys. Not into 100. This would be, if you want the holding period, you have to take 365. Why? Because you need this number of days. That's a mistake there. And raw material holding period also, if you want it in days, you have to take 365. If material usage cannot be determined, purchase can be used instead of this denominator. If anybody noticed, yeah, it's raw material inventory divided by the material usage in a year. Yeah. But if you don't have material usage, just use purchases. Good enough. Right. Then we have work in progress holding period. Again, it is work in progress held divided by production cost multiplied by 365, not 100. Please note. Yeah. Then if production cost cannot be determined, cost of goods sold can be used. Yeah. If you don't have the production cost, use the cost of goods sold. Then finished goods holding inventory, finished goods inventory holding period. Again, it's finished goods inventory held divided by the cost of goods sold. Yeah, what it relates to, of course, multiplied by 365, not 100. Then working capital turnover, it is used to measure how effectively management is utilizing its investment in working capital to effectively generate sales. Yeah. Basically, we have seen asset turnover. If you guys don't know what asset turnover is, it's sales divided by non-current assets, yeah, or the total of assets. to see how much revenue are we creating as compared to our assets. Yeah. We call that asset turnover. Similarly, you can do working capital turnover also, which is simply sales revenue divided by net working capital. Yeah. Then moving on from there, guys, we have a question here, illustration one. Let's check out this question. What do we have to calculate? Okay, using suitable working capital ratios and analysis of the financial information provided, evaluate whether Lisbon can be described as overtrading or undercapitalized. All right, let me pull up an Excel sheet also. I hope you guys can see my screen. Yeah. So if you guys can, let's try to do this question. Yeah. So here, yes. Okay, actually, yeah, actually, you guys should be trying this as a homework question. I think, yes, I will leave this as a homework question for you guys. I should be leaving something as a homework question, right? And we'll be trying this in the next class. Yeah, it is simply a comparison question, guys. It's too easy. You just have to use the ratios that you learned just a bit ago. There is nothing too hard about it. Yeah. So keep that in mind, right? And this will be a homework question. We'll be discussing this in next week's class, but it's too easy otherwise. Now, moving on from there. Yes, up next we have work Chapter 12, Working Capital Management, Inventory Control. In that case, maybe then, yeah, okay, actually scratch that, guys. Let's try this question because if I left this as homework, yeah, let's not start on a new lesson today. My plan was to finish this chapter. So I would like you guys to try this question. Yes, but at the same time, we will try this question here also. Yeah. So then 2013, 2012 numbers are given. Let's first look at revenue, right? So I can see that revenue has increased. So let me open up an Excel sheet over here. What is it saying? So guys, revenue is supposed to be, yes, for 2013 and for 2012, revenue was in 2013, it was 29,050. It's actually 29,050,000. For 2012, it was 20,750,000. All right. Yeah. Now, what is the increase in revenue? This would be this divided by, well, this again. Yeah. There you go. That's an increase of 40% in revenue. Cool. That's nice. Yeah. But do we see the same in the profit margin and such? Yeah. That's what we got to look at, right? If I calculate the profit margin, let's calculate net profits. I think what has been given to us. Yeah. If you guys can see this, I can see profit before interest and tax. Yes. I think we can use that operating profit margin. Yeah. Some people call it net profit, but I like to call it operating. I like to call it operating profit margin. Yeah. What is the operating profit margin? Yeah, what were the numbers? It was 8134 and 7470. So 8134 divided by, yeah, the revenue of that period multiplied by 100. Yeah. Similarly, right, that is 280. Oh, wait, multiplied by 100, 28%. Yeah. And the operating margin, excuse me, guys. The operating profit margin for year 2012 will be, yes, what is the profit of that was 7470 if I'm not wrong. Yeah, 7470 divided by the revenue multiplied by 100. I'm getting 36% as the operating profit margin. So the operating profit margin has actually decreased. That is not a good sign. Yeah. Then what else do we know? We could calculate things like current ratio, which tell us about liquidity. Does the company have enough liquidity? So let's take current assets and the total of current liabilities. Now, what are current assets total? I see 10,698 and 5,652. Let me just put that down. 10,698. Yeah. These are current assets, guys. I haven't put in the formula. This is 5652. Yeah. So what are the current liabilities? So current liabilities seem to be 8,730 and 3,774. Yeah. So current ratio, all right, is equal to 10,698 divided by 8,730. That's 1.22. Okay, 1.2 is not bad, but we got to see if it was higher last year, if it has decreased this year. Yeah. Last year it was divided by 3774. If you guys didn't notice, yes, that was right over here, the total of the liabilities, current liabilities. Yeah. That is how I've calculated this. Looks like this company's current ratio has deteriorated. Now, what about quick ratio? Well, quick ratio uses the same formula, but remember one thing, to take out inventory. Yeah. So how do I take out inventory? How much was inventory? Right, inventory was 4,298 in 2013. All right, so that gives me 0.73 as the quick ratio. And in 2012, yeah, I'm going to copy the same formula, but remember to remove inventory. Right, 2184, 2184. Yeah, this is what I'm getting. Zero point 0.9 was the quick ratio, which is actually a better quick ratio. Now, this, yeah, the quick ratio has deteriorated. That doesn't look so good. Now, that being said, let's also calculate the efficiency ratio, guys. Inventory days. Yeah. Inventory days would be inventory divided by, yes, your purchases or cost of sales. Since we don't have purchases, let's take inventory, that is 4298 divided by, if I go here, you can see the cost of sales 20,916. Yeah. Multiplied by 365, because we need it in number of days. Oh, 1 second, guys. That's my iPad. Hey Siri, cancel. All right. So if you guys can see this, so, apologies on that. Now, inventory days, yes, what else? For 2012, the inventory was 2,184. Yeah. And 2,184 divided by the cost of sales was 13,280 multiplied by 365. That is 60 days. So inventory days have increased. That's not a good sign. What about receivable days? Well, receivable days are based on receivables. Let's see what receivables were. 6,400 divided by, yeah, your cost of, sorry, revenue, because we want to assume that all of the sales was credit sales. So that gives me 80 days, right? And receivables, yes, for 2012, the receivables were 3,468. Yeah. I hope you guys can see my screen. 3,468 divided by what was the revenue? 20,750. Oh, yeah, revenue is here also. 20,750 multiplied by 365. Sorry, not 265, guys, 365. You can see that the receivable days have sharply increased, almost by one third, 33.3% increase in receivable days. That's not a good sign. Now let's put down payable days also. Payable days would be, what are the payables in 2013? 5,730 divided by the cost of sales, because we don't have purchases or anything. 20,916 multiplied by 365. I'm getting payable days as 99, or roughly 100 days, 99.99. Now, what about in 2012? The payable days were 3,274 divided by whatever the cost of sales was. That was 13,280, much lesser cost of sales, multiplied by 365. It was 90 days. Even payable days have gone up. This is usually an example of over trading, that is undercapitalized. Now, we can calculate other ratios also. For example, uh, how much is the net working capital, right? As a number, yeah, we can see if working capital has gone up, this will be the difference between the current assets and the current liabilities. I know the current assets are 10,698 minus the total of current liabilities is 8,730. This gives me 1,968. Let's see how much this was in the previous year. In the previous year, it was 5,652 minus uh 20, whoa, that's not, okay, 3,774. Okay. So 1,878, yes, there is an increase in the net working capital also. Another thing that we can look at is working capital, yeah, turnover. Now, working capital turnover, sales turnover based on, I mean, it's basically sales, 20,950 divided by the working capital amount. Yeah, the net working capital was 1,968. Yeah, that is 1.968 million. Similarly, I can do that for, yes, 2012 also. Now I can compare the working capital turnover. So working capital turnover is higher. Yes, we are making better use of our working capital turnover, but there could be a possibility that this company is, well, over trading. Yeah. So that is definitely a reality. Watch out for that, guys. Now, that being said, right, that was the last question here. This is still a homework question for you guys. I want you to try and analyze these numbers. What I just showed you and told you about is the calculation. There are some more connections that you guys can make. Up next, we have chapter 12, working capital management, inventory control. I'm not getting into that. For some reason, I'm not feeling too good. Yeah, maybe it's the sandwich I just had. Right. Anyways, I'm leaving you guys here. Right. Next class, we'll be starting off with chapter 12. Yeah. Let me just make a note of that. All right. So I made a note of that, guys. Yes. And we'll be meeting on Friday. So take care. Yeah. And thank you. Sorry, I'm leaving you guys 5 minutes early. Right. I'm not feeling too good. Right. Anyway, we finished our chapter for the day. So thank you and bye.